Okay, so let's hit some,
Yeah.
please.
One of the things I was hoping you touch on a little is the buyers of this have very little information about, have often very little information about how the companies are doing, what their plans are, what you might want to form an investment judgment based on. I mean, Facebook's a pretty well-known company, but lots of other.
Oh, you just hit myths 3 and 5 already. I love it. Okay. So.
If you're going to hit it in 3
Yes,
and 5
yeah.
until then, but I'd love to hear.
Great questions.
Your take on that.
Great questions. Okay, so the first myth, it's illegal. And we don't hear this that much, but we do hear it. So I'm going to debunk it. So I'm not in jail yet. There is a warrant for my arrest. No, seriously. It's at the end of the day, there's rules and there's exemptions that you have to kind of comply with to kind of basically stay out of jail. And we're regulated, so we have the SEC and FINRA come through once a year or so, kind of make sure that everything we're doing is proper and we have a clean record. But I think that the biggest things that we have to be careful for is, unfortunately for now, the buyers on SecondMarket are limited to what are called accredited investors. And an accredited investor is basically the SEC's poor attempt to define what a sophisticated investor is. And the definition is you have to have $200,000 in income or $1 million in assets. And so the way that the regulators look at it is that if you have a lot of money, you're smart enough to make these types of investments. So, arguably, the past 2 years have proven that that's not the case. But so we have to make sure that buyers are accredited. We have to make sure that we're not allowed to kind of push out there into the public what's for sale and the prices things are for sale. As much as we would love to talk about Facebook's valuation all day long. We'd love to, you go to our website and list everything that's for sale, but the regulators wouldn't like that very much, and in fact would end up in jail, which I don't want to do. Okay, so next myth. I'm going to lose control of who is buying and selling my stock. And I think had we launched this market differently than we did a year and a half ago, I think that this would have been reality. But what we realized was that the solution here was to work with the companies to essentially create a market that's customized for that company. So we use the term micro market. So with these companies that we're working with, we basically set up a place on SecondMarket where they control every aspect of how the market works. So this is not an eBay or 24/7 market or NASDAQ. We allow companies to decide who the buyers are. So companies can have like an approved list of 50 or 100 buyers. Companies can decide who can sell. So can employees sell? How much can employees sell? The companies get to decide what information is shared with these buyers. And most importantly, and this is usually a surprise to everybody, is companies also get to decide if they want to, when is the market open? So everybody's used to kind of the public market, like 9:30 to 4 type trading window, but a lot of companies we're working with, they're now going towards like a once a year auction or a once a year like liquidity window. And I think that makes a whole lot more sense than having your stock traded every single millisecond by these high frequency traders. Slow things down, kind of bring investors back into the market and kind of get away from kind of this trading, this casino type mentality. All right, myth 3. I'm going to blow through, I guess it wasn't 3, I think it was 4 and 5. So I'm going to blow through the 500 shareholder count rule. Okay, who knows what this rule is, what the issue is? In the back. Is that a hand? No? Yep. 500 count. Why do we care?
Because then you're a public company. Essentially, you're selling to a large shareholder base.
Yes. So this sucks. So if you have 500 shareholders, you have to then start basically acting like a public company without having the public company listing. So I think it's been reported that Google accelerated their IPO because they blew through the 500 shareholder count. And I think Facebook a few years ago changed the way that they compensate employees by using restricted stock units, which is kind of a clever way to kind of get around this shareholder count. But the myth is that if I have my shares trading on SecondMarket, I'm going to blow through this count. So the reality is that when you set up this market, you're controlling who the buyers are. So you can actually use the secondary market to consolidate shareholders. So what we actually see more frequently than the numbers increasing is they actually decrease. I think we just worked on a company, Jeff, how many shareholders did we reduce This
20%.
20%, yeah. So in number, how many do you think we reduce it by?
I think they were up north of 300.
Yeah. So a good 50, 60 shareholders were removed from the cap table. And that's great because that means that company can now use their stock for acquisitions. They can pay their employees more in terms of stock options. Okay, myth 4. The world is going to see my financials. So this is kind of along the lines of the disclosure question. Again, the misconception is that if I do as a company want to provide investors with any information, it's going to show up on TechCrunch or on the Wall Street Journal. And the reality is that's not the case. Because when you set up this market, this micro market, you're basically deciding who the buyers are. Companies are more willing to share information through the system. And companies are sharing lots of different types of information. Some companies are saying, okay, here are my audited financials, here's my cap table, and other companies are providing budgets and projections and things like that. But this is the best part, is that companies are creating, again, a kind of a customizable information package depending on kind of where they are. So if you're a company that's 4 years old, you don't want to kind of get into product level revenue detail, and you just want to do top line, great. That's all you're going to give the buyers. But if you are 10 years old and you're a mature company and you're ready to kind of provide kind of top to bottom line type detailed financial info, that's fine as well. And because you're providing it in this kind of closed wall environment, you're more comfortable providing it to investors. All right, myth 5. This is only for the Facebooks of the world. So I think that this is partially true still, but I think it's changing. So when we started in this market in 2009, we decided on purpose that we were going to start off with Facebook, of course, because we didn't want to become the pink sheets or like this. There's this AIM market in London that basically it's like these crap marketplaces that you didn't want to go to. We said, okay, we're going to go after the best companies first, and then we're going to expand it from there. So as you saw from the chart or the slide a few slides ago, it was Facebook and LinkedIn and Zynga and Twitter, and now it's broadened to 40 companies. So this is kind of what we look for when we start developing relationships with companies. It's a company that's done a few rounds of capital. They're, at this point, they're profitable or getting close to it. $150 million valuation. They have to have enough shareholders for there to need a marketplace. If you've got 2 people owning your stock, you don't really need a market. You need an investment banker, unfortunately. And then lastly, companies that are high growth. So there's lots of really great companies out there that have all these characteristics but are just boring businesses. We don't want them. Not now. I mean, we want a SecondMarket to really kind of emerge as the premier marketplace where companies that are private go to on their way to becoming public, or you know what, maybe they want to stay private permanently. But I think for now, if you look at the 40 companies, I think the smallest of the 40 companies is probably going to be around $200, $250 million in value. Now, obviously, it's my goal that I want to expand this to companies of all different shapes and sizes. I want to get this down to the point where the types of companies that could have gone public 2 decades ago, the ones that were doing $5 million IPOs, we want them to be able to get liquidity on SecondMarket. So why is this a great thing? I mean, who thinks this is not a great thing? I'm just curious. Come on, challenge. Why is this bad? Anybody? So I don't have to do this? Okay, yeah.
Because what are the overhead costs in terms of transactional shares? Like the random walk down Wall Street model of the world is low transactional costs, and great companies means that we all win. And if there's a high middleman cost, it's detrimental to investors and go on.
Yeah, so I think that...
Repeat the question. Do you want to repeat the question? No, you, Barry. So be able to...
Okay, so the question is and correct me if I'm wrong. So the question is so SecondMarket is kind of is a low volume, high transactional cost type platform, and the theory is that companies should be better off always in a public market with higher volumes, lower transaction fees. Is that?
No, not always.
Okay.
But generally, lower transaction fees are better for people who buy and sell shares. And I'm being devil's advocate here. I do think this can be a good thing in the right case.
Are you just saying we're too expensive?
He wants a deal. Give me a discount. You and I ever talk.
All right. You get the friends and family discount, my friends. Yeah, you know what? I mean, look, we're trying to build a really big business, and our transaction fees, just so you guys know, they tend to be like 2 to 4% per transaction. And obviously, when you can buy stock in the public market at $8 a share or $8 an order, it's a different type of transaction model. Having said that, our average transaction size is about $1 million, $1.5 million. So we make our money on larger transactions with less frequency. But I think that that's a good thing, because I think like the problem with the public market with this high frequency crap and just the casino mentality is that we've gotten so far away from investing in stocks, and now it's all about trading, that I think it's actually a good thing to have higher transaction costs to slow things down and create some friction in the model. Because you know what, I care about who my investors are. I like to get to know them, and I like to know that they have got a similar kind of time frame as I do in terms of how long they want to stay involved in the company. 2, 3, 4, 5 years. If I thought that they wanted to flip out of my stock in 3 or 4 months, I'd create as many roadblocks as possible. So fair points, but I think ultimately our fees will go down, unfortunately. But I think in the meantime, I think it's a healthy part of the model. So you don't think it's a great thing either? Killing me.
I like it. I just had a follow-up question.
Oh, okay, good.
You talked about IPOs and acquisitions as kind of historically the two ways for founders and employees to cash out. What about private equity firms, whether it's venture capitalists in a future round providing some liquidity or a leverage buyout type thing? How does that fit into this whole picture?
So the question was, there's 2 paths to liquidity I talked about. One was IPO, one was M&A exit, and then I mentioned this third path. The question is, there's this growing number of called private equity firms that are providing liquidity as well. And I think there's even like the DST type deals, if you guys are familiar with what they did with Facebook and other companies. So I guess the way I look at those is, one is the private equity guys, they tend to do kind of control type transactions. Like it actually is an M&A transaction. It's just that it happens to be a financial investor versus a strategic buyer. But I think the emergence of these DST type deals, for those who are not familiar, DST, I guess Russian investor comes in, buys some preferred stock, and then they tend to also provide some liquidity to shareholders as part of the deal. It's actually not mutually exclusive because those investors are buying through SecondMarket and they're also buying directly from the company. I think ultimately, I think it's a great thing because what they're doing is they're actually coming in and they're completely changing the economics of these deals, whereas historically it would have been, there's a group of like growth equity firms like TA and Summit that would come in and they'd do another preferred round and you'd get stuck with dividends and liquidation preferences and all that. DST comes in and says, shit, we'll take common stock, and we're not even going to take a board seat. And you know what? That actually makes sense for these companies because at that point, you really don't need usually the type of involvement or influence that you get from some of these later stage private equity guys. Okay, so 1 second. So why is this such a great thing? If I do say so myself. Okay, so one, we haven't really talked much about this, but if you think about this market, it's a great way to attract and retain employees. Because for everybody here who's kind of giving out options to your employees, if they're thinking that I got to wait 8, 9, 10 years to get any liquidity, you're wasting your equity. You're giving to them for no reason. But if you can say, you know what, after you vest, we're going to let you sell 5% of your stock per year, 10% of your stock per year. I think that's a really healthy thing. And what it does is it puts value back in your stock. And you get away from this lottery ticket mentality that a lot of employees think about as relates to their options. Yep.
So especially founders, will be selling common stock. So how do you deal with the issue of pricing the common, and what impact does that have on the 409A valuation?
So, okay, is everybody familiar with 409A? Okay, who wants to take the 409A question? Who wants to explain that? Any valuation guys in the room?
It's all yours there.
Ben? All right, so 409A is essentially the rules under which that everybody issues options each year. It's the fair value calculation for purpose of the strike price. And so basically, every year, at least once a year, companies will do a valuation, and that's your 409A valuation, and that's a price at which your options get struck. Now, the little game, the little secret that everybody plays, don't tell anybody, is you strike your options really low. And you do that for as long as you can get away with it. We don't do that, for the record. But you do it for as long as you can, because it's kind of like free money, or at least it's perceived as free money to your employees. So the issue here, and the question is what effect does secondary trading have on your 409A? And since this is kind of a new issue, the secondary trading, I think kind of the jury's still out. But what everybody seems to be figuring right now is until you reach a certain amount of volume in a particular year, the prices on the secondary market, it is an input that valuations firms will consider, but they'll consider it along like a discounted cash flow and a market multiple and all of that, and they might affect your valuation for it, but not until it becomes 5 or 10% of your trading, or trading as in a given year. But you know what? If your stock is turning over 5 or 10% per year, that's the value. So you don't even have to go hire a valuation firm. You actually have set a value. So what we typically advise companies to do is if you are in the habit of issuing very, very cheap options under the money, we encourage companies to actually not directly get involved with their marketplace until such time as the value of the options has approached the value of the market. Because by companies basically saying, look, we were not directly involved in these transactions, the belief is that the valuation firms can say, look, this is these transactions over here, these are not kind of company-supported transactions. I think over time, I think what will happen is the compensation plans will be put in place that actually provide for some type of liquidity and are not completely dependent on issuing really, really cheap options.
So can I follow up? And if you want to take this on offline, we can do
Okay.
that. But, specifically dealing with founders who are selling founding stock, right? And there's been previous rounds of funding in the company which have set a price to the preferred. And typically when you get into an M&A type situation or you get into an IPO, everybody converts and you're all selling at the same price, right? But if you're talking about founders who are selling common and there has been a price set by the investors coming in and buying preferred, what range do you see in terms of what founders can sell their common stock? Is it like what percentage off the preferred price?
It's a good question. So the question is, what is the discount off of the latest preferred round? And really what actually ends up happening is it depends on how much time has gone by between the last preferred round and when the stock trades. So there's plenty of examples where a company doesn't raise money for a couple of years and the stock is trading at a huge premium to the preferred round. I would say generally speaking though, if you do a preferred round and then immediately see a common stock trade, it tends to be somewhere around 20 to 40% discount off of the preferred round. Yep. All right, so why else is this great? It's easier to raise capital. So if you can tell investors that, hey, we've got a marketplace for our stock, they're going to, at the very least, penalize you a smaller liquidity discount, which is basically the discount that investors apply between a public company and a private company. So you're talking about easier to raise capital, and it's also better valuations. What else is this great? You're providing options to yourself and your management team and your shareholders. And I don't mean stock options. I'm talking about options for the future. So you are giving yourself the ability to not have to go public if you don't want to, or not do an M&A transaction if you don't want to. Next, this is great because you can go for it. You know, the way I look at it is if you can allow your employees and your shareholders to get some liquidity, what you're doing is you're de-risking the situation. So if you guys, like me, have all of your net worth tied up in your company, and you can get a little bit of money to pay for the mortgage, buy a car, put kids through college, you're going to swing for the fences. And I think ultimately, I think a lot of people in the room, you want to build really big companies like I do. But if you are always thinking about, you know what, if I make a stupid decision, my company's going to go down the toilet, and you're going to lose all your net worth, you're going to really kind of change the way that you run your business. So we think that having this marketplace and getting some liquidity is a great way to de-risk and go for it. And I think this is important. This is great because you can stay private longer. Because ultimately, for a lot of companies, I mean, an IPO path might make the most sense, and you really don't want to go public until it makes sense. You don't want to go public until the market's going to embrace you as a public company. And so having the extra 2, 3, 4 years as a private company, I think is really important. And lastly, I think this is great because it enables you as entrepreneurs to control your destiny. So you're no longer subject to the pressures of your venture capital firms, of former employees, of employees who are demanding that you provide them liquidity, and you can control your own destiny. And that is it.
Two more questions. You already had your question.
I'll get another one.
In the blue, in the blue, in the blue.
This kind of market obviously has a big potential for a lot of information arbitrage. So there's a lot of people that sort of know a lot about these companies and have a lot of connections to people elsewhere who have money to invest in companies. Are you seeing a bunch of funds spring up around this?
When you say information arbitrage,
Well, I just mean in that, I mean just simply in that there are a lot of people around here who understand a lot more about what's going on in these companies than, say, my friends in London who understand about what's going on with these companies and a lot of potential to funnel investment. Are you seeing that happen, people setting up funds?
so the funds that are getting created right now, it started off as single name funds. So like Facebook was, I think, probably the first one. And that was that there's a ton of people that would like to buy Facebook stock. But on SecondMarket, you have to write $1 million, $2 million check. And a lot of people want to put $25,000, $50,000 to work. And so what's happening in that example is funds are getting created to buy $10 million, $20 million blocks of Facebook stock in like $25,000, $50,000 increments. But for those funds, it's not a matter of having information. It's really just a kind of like a facilitator of getting these transactions done. I think that there's a number of guys out there like Ben over there who are I think the next generation of investors that I think are going to be really successful because they have dedicated capital, they know how to look at these companies, they're patient capital, they know how to do research, diligence about them. And I mean, I got to tell you, I mean, the 40 companies that are trading on SecondMarket, I feel like every single one of them over the past year or two has gone up in a pretty big way. And you look at the public market, and I don't know, over the past 2 years we're probably flat. There's a lot of money to be made here. And I think we're going to see more funds like that are going to get created, and they're going to take advantage of. And I don't know if I would say information arbitrage. I think it's really just kind of more of kind of a specialized investing technique. But what I can tell you is the public market, the mutual funds are, you're getting S&P type returns. Hedge funds are, depending on the month, they're up 10%, down 10%. Venture capital as an industry is going through its own issues right now. So I personally think that this market, this private company market, I think this is the next big thing. I think that this is going to be the new place where people start allocating a portion of their capital. Now, granted, it is limited now just to accredited investors, but I think people are going to start saying, you know what, I want to have 10% of my money in this private company market because this is where the returns are. One more question.
Can you now, or do you foresee a time in the future when you can go short in this
market.
Who would you short right now?
Proprietary.
Okay, so I think the answer is yes. Yeah. But it's not going to be SecondMarket doing it. Like I said before, I'm passionate about this because I want to create a better market for all of you guys. But ultimately, someone's going to figure out a way, through derivatives or some other way, to kind of create some, real or kind of artificial short opportunity. But ultimately, I think it's probably healthy to kind of have that. Some level of that, not like we have in the public markets, but some level of kind of contrarianism in the private equity market is probably healthy. But again, that may take 10 years to get there. But I do want to hear who you want to short, though. All right, I think we're supposed to wrap it up. So.
How many more do we have? Okay.
Thanks, Larry. So my question is really for when you're talking about Facebook and Zynga and Twitter, these are all companies that are consumer companies that have a lot of awareness about them. But what if you have a company which is a non-consumer company where founders are actually looking for liquidity? What can you guys do to actually create the market and find buyers who may actually be interested in buying that stock?
Did everybody hear the question? So I think that it depends on the type of company you're talking about. But as I mentioned before, we wanted this to become kind of the place where the hottest, fastest growing companies go to trade. And if it is not one of those companies, we're going to need a few years, I think, to kind of get there. But if it is kind of a hot, fast-growing company, but maybe it's not a consumer-facing product, maybe it's something else, I think the chances are is we have about 25,000 buyers buyers and sellers have signed up. I would say that we have investors, on SecondMarket that are ready to roll. So we've built into our system pretty robust profile information about all the investors. We have like a matching algorithm. So if it's a clean tech company that's this stage in this geographic location, we can pull out through our system a group of 50 investors that would make sense for that opportunity. Yep.
Any other questions?
Actually, did you want to mention a little bit about how the share price is set or how much it fluctuates over time? Just like people are always throwing out, Facebook's worth this much or that much, but can you just walk us through what exactly it means, how valuations are set for the per price share and how much it changes in a market like this?
So generally speaking, the prices are set by the market. And so ultimately, something is worth what someone's willing to pay for it. And so, what we see in most cases are kind of negotiations happening between the buyer and seller setting a price. However, what we're transitioning more towards is our auctions, and specifically Dutch auctions. And so basically, people know what a Dutch auction is? Essentially, in a Dutch auction, everybody clears the same price. So you can have multiple buyers, multiple sellers, and everybody gets the same price in that auction. There are cases where the companies will actually identify in advance a small group of investors and say, hey, look, we want to provide liquidity at this valuation range and have a negotiation with those investors first, come up with a value, and then they go back to the shareholders, and basically it equates to kind of a bit of a tender offer. So we're seeing kind of, called free markets, auctions, and then a kind of a guided market price.
Any more questions? Marcus.
What about hypothesis shares and options?
So the question, is about the ability for you to essentially get a loan on your shares or your options and using them as collateral. That's the direction you're going, right?
Yeah.
Okay. So in most kind of purchase agreements, when you have stock and you have options, there's kind of a clause that says you cannot lend or basically hypothecate out these shares. And I think it kind of gets back to the short selling question, because if people could do that, what will happen is that people will start lending out their shares and they'd be getting sold short. There's really kind of nothing that we're doing that I think is going to change the way that these options and stock grants are being drafted. Having said that, there's a few groups out there that are actually starting to come up with funds who are providing loans to employees to exercise their options, to start the holding period tax holding period clock ticking. So the idea is it's actually a tax arbitrage. So if you expect to sell your stock in an IPO or some other type of transaction, the problem is if you have options, when you exercise those options and you sell your stock, you have a short-term holding period. And so you basically pay ordinary income taxes, which sucks. But if you had exercised your options and got your clock ticking, you would pay long-term capital gains, which currently is still a pretty big differential. So we're aware of some groups out there that are trying to come up with solutions to this hypothecation issue so that they can provide these loans to employees to exercise their options so that they can basically screw the IRS. Did I say screw the IRS? I meant comply with all that. No, it's completely legal. It's just there's some creative structuring to be done to be successful.
Quick question. Just, so when people buy these stocks, do they have to wait for a liquidity event, or do they have options to trade it as well?
In most cases, they're free to resell. Some companies that are trading on SecondMarket, they decide to put certain restrictions on the ability to resell in terms of timing. So really, it's up to the company ultimately, but generally speaking, they could resell immediately. The regulations require a certain amount of time you have to hold on to it. Like 60 days is kind of a good rule of thumb. But we don't see a lot of turnover. I mean, people are investing with a few-year time horizon.
All right, let's actually wrap up because we have table conversation. Thank you, Barry, so much.